Today, stemming the New Zealand home price nosebleed. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Late last year, in fact on the 24th of November, the Reserve Bank of New Zealand received a letter from the Ministry of Finance in New Zealand seeking views on ways to address the Minister's concerns regarding rising house prices. And the Reserve Bank Governor Adrian Orr responded to that letter on the 9th of December. The momentum in the markets remain strong, very strong, on lower interest rates and high demand for credit, of course stoked by the quantitative easing strategies being executed by the Reserve Bank of New Zealand. And to get a sense of just how strong those prices are, let's look at the QV House Price Index data, which was just released, showing that the average value increased by 6.27% nationally over the past 3 months, up from the 5.35% quarterly growth that we saw in December, with the average value now sitting at $838,826. And this represents an increase of 15.11% year on year, an increase from annual growth of 11.24% last month. Now, QV said that the major urban centres continue to show strong gains in value over the past 3 months, with Tauranga and Palmerston North leading the way with 10.46% and 9.19% growth respectively. The larger centres were generally first to show the rapid value growth, and this was primarily driven by both first home buyers and investors competing for very limited supply of entry-level housing stock. But the market strength is now spread to the higher value locations in the major centres as confidence returns in the post-lockdown economic recovery. The rapid and sustained residential value growth has compounded affordability problems, they said, making it difficult for first home buyers to put together a deposit in the bigger cities. This appears to be the main impediment for first home buyers entering the market. Now, across the various regions, Auckland residential property prices picked up from where they left off last year, posting a rise of 2.1% in January 2021 and an increase of 5.56% for the quarter. The average value for the region is now $1,207,860. The biggest gains in this quarter were made up on the North Shore, where prices shot up 6.15% in 3 months to a new average of $1.38 million, and was followed by Auckland Central up 5.99%, Rodney at 5.47% and Franklin at 5.45%. The residential property market remains hot in the Wellington region, where QV's latest house price index shows property prices increased by 8.32% this quarter and a whopping 21.26% over the last 12 months. The average house price across the region is $932,000, although the average value is obviously higher in Wellington at more than $1 million, where house prices climbed 7.59% in the quarter. And Nelson's also seen strong lifts in values over the past 12 months, with low interest rates, lack of supply and returning Kiwis all helping to put upward pressure on residential property prices. The average price of a home there is now $719,000, and that's 3.98% higher than it was 3 months ago and 9.46% higher than it was a year before. And Dunedin's hot residential property market is showing no signs of slowing down during the early part of 2021. The city's average home price has increased by 5.42% this quarter to $616,000. The biggest rise was in Dunedin South, where values have increased by 6.76% this quarter to a new average of $582,000, followed by the Peninsula and Coast, where the average house price has grown 5.63% to $556,000. And Queenstown's residential property market seems to have sprung back into life following a difficult year that saw the closure of New Zealand's borders to tourists. Its average house value has increased by 9.68% over the last 6 months and 6.51% this quarter to $1.3 million, and the 12-month average is 4.72%. But now the Reserve Bank of New Zealand has announced it will be putting in place more stringent loan-to-value ratio restrictions to reduce the risks to financial stability caused by high-risk mortgage lending. The LVR restrictions do not apply to new residential construction. LVR restrictions were removed in April 2020 to ensure they didn't interfere with COVID-19 policy responses aimed at promoting cash flow and confidence. Reserve Bank Deputy Governor and General Manager of Financial Stability, Jeff Bascard, says, since then, in part due to the success of the health and economic policy responses, we have witnessed a rapid acceleration in the housing market, with new records being set for the national median price and new mortgage lending continuing at a strong pace. We are now concerned about the risks a sharp correction in the housing market poses for financial stability. There is evidence of a speculative dynamic emerging, with many buyers becoming highly leveraged. A growing number of highly indebted borrowers, especially investors, are now financially vulnerable to house price corrections and disruptions to their ability to service their debt. Highly leveraged property owners, in particular investors, are more prone to rapid fire sales that potentially amplify any downturn. These financial stability risks exceed the situation at the time of the bank's December LVR consultation, resulting in more restrictive policy settings being decided on. And so, as of the 1st of March, the Reserve Bank will be reinstating LVR restrictions at the same level they were set to prior to the onset of COVID-19, with a further tightening of investors' restrictions taking effect on 1 May. The two-step process is necessitated by mortgage lenders' operational capabilities. So from the 1st of March 2021, LVR restrictions for owner-occupiers will be reinstated to a maximum of 20% of new lending at LVRs above 80%, and LVR restrictions for investors will be reinstated to a maximum of 5% of new lending at LVRs above 70%. But from the 1st of May 2021, LVR restrictions for owner-occupiers will remain at a maximum of 20% for new lending at LVRs above 80%, but LVR restrictions for investors will be further raised to a maximum of 5% of new lending at LVRs above 60%. We expect mortgage lenders to respect the 60/5 investor restrictions immediately with all new loan approvals to ensure that their mortgage lending is consistent with our policy decisions, Mr. Bascard said. And of course, the public consultation on the proposal to reinstate LVR restrictions was carried out in December last year. And QV commented that, sure, these restrictions may have some impact, but they're still expecting house price growth ahead. And with the return of LVR speed limits in March this year, we may see a gradual cooling of the market in the second half of 2021, particularly in the entry-level locations as property investors reach their credit limits and first home buyers struggle to raise a deposit. But with the long-term forecasts for housing demand in New Zealand looking positive, it is difficult to see the market take a significant turn for the worse anytime soon, they said. But I guess you would expect that from them, wouldn't you? Now, my point is sure, New Zealand does need to get house prices under control. The rate of acceleration from already high loan levels and high price levels is, frankly, astonishing and highly risky. Unfortunately, it's been stoked by the Reserve Bank's policy settings and quantitative easing. So in a way, they're trying to shut the stable door after the horse has bolted. These LVR restrictions will indeed have some impact and are likely to tame house price growth to some extent. But bearing in mind they're still not putting controls in place to deal with the speculative construction, which is rife at the moment, and the fact that there is still strong demand and incentives for first home buyers, it seems to me that this isn't going to be sufficient to tame house prices anytime soon. So expect more lifts in prices, but also expect the Reserve Bank continues to be worried about the financial stability implications. But of course, the truth is, it's down to individual borrowers and their exposures. And it's clear to me that we're going to see higher levels of difficulty ahead as more households get ever more into debt. That is a theme that is as true in New Zealand as it is in Australia. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.